All right, Rashesh Shah of Edelweiss joins us. Before I just connect with him and ask the first question, I just want to mark what's happening to the Edelweiss stock here. And the stock, in a sense, has been on the receiving end of the market mayhem. Right now, the sentiments for NBFCs is not looking all that great. The general view is that, let's say, a year and a half ago was that NBFCs can only go one way, which is higher and higher, because they were really doing all the heavy lifting for the credit offtake in the system. Now the view is that NBFCs can only go one way, which is lower and lower, because all NBFCs have got bad exposure. They're not getting credit line. They're not being able to raise capital. So there are two things which are troubling markets. I think that's at least my assessment, and I'll get Rashesh to address both of them. First, availability of cash or liquidity, and B, exposure to real estate and other corporate groups where recovery would be slow. Rashesh, which point do you want to start with? Because they are both issues we'll address today.
True. I think I would like to start off by also saying that, though Edelweiss is seen as an NBFC, we have NBFC business, but we are a diversified group. We have asset management, wealth management, ARC, and a lot of other. We also have retail credit in NBFC. So we are always been focused on being a diversified company. To answer your questions on both of them, I think availability of credit has been fairly okay. I think it has come down from last year, but in our case, since we are not overall growing the book, what we have a stated strategy that half our credit book is wholesale and half is retail. Whatever repayments are coming in wholesale, we are using it to grow retail. So in a way, what we are doing is the overall book is not expected to grow, but the wholesale retail mix will become more and more in favor of retail. So the availability of liquidity, the bank lines and all have been fairly okay. In fact, this quarter, I think for most NBFCs, the partial credit guarantee scheme will get operationalized. And our expectation is in this quarter almost about 40,000 crore, 35 to 40,000 crore of the asset portfolios of NBFCs will be bought by banks, and there'll be a huge release of liquidity, because the scheme was announced 3 months ago in the budget, but it has taken 3 months to operationalize it. So even now it just finalization stage of operationalization of that. So once it gets operationalized, about 35 to 40,000 crores will flow from banks to NBFCs, which will also give a lot of additional liquidity to NBFCs to on-lend. So I would think that once that starts, the credit cycle should start coming back, because liquidity has improved. RBI has pumped in a lot of liquidity, but the transmission has been slower. But I hope that this quarter is the one where transmission also happens. And if you're not overall trying to grow, then you don't need too much liquidity. On the other one, about corporate book and wholesale book and all, the cash flow stress has been there for last almost 1 year. The only good news on that is it's been 1 year old, and everybody has understood, readjusted the cash flow assumptions and the models on that. So there is no unknown anymore. Everybody knows what are the cash flows to expect, and everybody is aligned with that. So on that count, and also on that I think the RBI easing off of liquidity is helping in the system in slow and steady manner. So I think another 3 and 6 months, I would think a lot of things should start coming back to normalcy for the liquidity in the economy as a whole.
When the IL&FS crisis was discovered or unearthed, NBFCs like yours were growing at 30%, actually more than 30%. You came out and you said, look, heydays of growth is behind us. I need to contract. I need to slow down. So you started consciously slowing down your business. That's one part which disturbed the market or led to a stock re-rating. Second is that post the IL&FS crisis, a lot of corporate groups were caught with their pants down because of cash flow mismatch. What they borrowed, they are not able to pay back. In this quarter, given that the SL crisis is not solved, HDIL is in a mess, ADA group has not recovered completely and fully, are there some specific SME or loans which you thought were good loans may end up becoming bad loans? And is that something which market should be wary of?
See, overall, until last quarter, there was an apprehension that stress will increase as the economy was slowing down and all that. But as I said, I think a lot of the measures the government has taken and the easing off of liquidity, and the good news is the public sector banks have got capitalized. Capital has come in for them, and they have started stepping up on the credit delivery in the economy. So overall, where credit was frozen around April, May, June, I think the banking system, especially PSU banks and all, have opened up the credit flow into the economy. So on that count, I am more optimistic now than maybe I was 3 months ago in terms of the credit flow and the freezing up of liquidity. See, a few accounts that you did mention, there is a liquidity crunch that has been there, but we should remember that Indian banking industry has gone through 5 years of NPA of almost about 12 to 13 lakh crores. A large part of that is behind us, and I think if you look at steel and roads and power, there were 2 to 3 lakh crore stressed assets in each of these industries. So we have gone through that. So fortunately, when the IL&FS crisis hit, a lot of the NPA crisis was behind us because the quantification and the provisioning had happened. So I think on the whole, the banking system is on a much better footing to make sure the economy doesn't freeze up and make sure that the free flow of credit continues. And I think that is what we have started seeing post-August. In fact, September, if you look at a lot of high frequency data for the economy, September things have started inching up a little bit. It's still early days, but all these are the green shoots. And I'm hoping that with RBI cutting rates, liquidity being there, PSU banks being in strong position, and government also making sure all the reform action and the push has been there, in the next 3 to 6 months, we should at least see things getting normalized, and then improvement should start. But at least they've stopped getting worse in the last 4-5 weeks.
Rashesh, just a short while ago, we were having an interesting discussion on the outlook for the NBFC space, and we had Tamal Bandyopadhyay with us, and he flagged off one of the key concerns within the real estate space, how the stress over there is likely to remain prolonged, continue into the next few years. Is that a big concern? Is that a big worry that, real estate as a sector will continue to remain beleaguered, continue to remain a pain point?
See, I think there is a liquidity stress across all the projects in India, whether it's real estate projects or other projects, because I think the project funding has started to dry off. The only good news is that this has been going on for 1 year. So as I said, there is no new unknown. I think a year ago, everybody knew that liquidity availability for real estate projects is going to be slow. The other good news is that these are all housing projects. And experience has shown in India that if the project gets completed, then usually recoveries and sales are not a problem. So the current effort is to make sure project gets completed. The other good news is, but it will play out maybe a year from now, the demand supply equation in housing has started to correct, because we always had oversupply. But in the last 1 year, as liquidity has dried up, very few new projects are getting launched. As a result of that, the supply of inventory will slowly and steadily get crunched. And as the demand comes back with interest rates coming down and banks pushing home loans and all, we should see the demand supply equation also getting corrected. But the most critical part in any project is to make sure the project gets completed. And also the other good news is that there are more than 5,000 projects in India where NBFCs and banks have funded housing and real estate. So at a project level, your exposure is a much smaller amount for any entity. So because it is spread over so many projects, and the projects are not as much correlated, because a project in Bangalore and a project in Bombay have no correlation with each other. So unlike a steel project or a power project, which are 5,000 crores and 10,000 crores and 20, 30, 40,000 crore, an average housing project is between 200 crore to 1,000 crore. As a result of that, the exposure of NBFCs and banks is spread over a lot of projects, and the projects that get completed, I would feel that there will be no haircut or loss or stress on those.
Rashesh, since we are on the subject of real estate, wanted to understand, when it comes to your own NBFC, what is the percentage of exposure that you have to real estate, A, and B, how much of that percentage is actually under stress?
So our total real estate book is about 11,000 on a balance sheet of approximately 55,000. So real estate is about 20% of our balance sheet as a whole. And actually that is what I always highlight, that we are a very diversified company. So at a balance sheet level, real estate is about 20%, but even at a P&L level, we have a lot of earnings from asset management, wealth management, ARC and all, which are non-NBFC related. We have a retail credit business, also SME loans and all those are not affected by all this. So we have a fairly well diversified P&L and a fairly well diversified balance sheet. Out of the 11,000 crore, the book is there, it is spread over 160 odd projects, and we have that in an investor presentation also, we have highlighted that. So this book is fairly granular because it's spread over 160 projects. Out of that 160 projects all along for the last 8-10 years, we have seen that about 10 to 20% of your portfolio is always under watch, because some intervention, some help, some hand-holding is required to make sure the project execution happens. Those parameters have not got worse. They are the same they've been for the last 10 years. And one of our core capability has been to make sure we provide oversight and liquidity to get the projects completed, because that's the only panacea in this, that if the project gets completed, your risk can be fairly contained. And we also have a lot of experience with ARC, because in ARC we acquired NPAs from banks and we have resolved quite a few of them. Last year we did 7,000 crores worth of recoveries in our ARC business. This year we are aiming for a 12,000 crore recoveries in the ARC business. So the fact is, if the underlying asset is good and economically viable, how to convert that into value will take effort, but can be done, and you can manage your risk in that way. So that has been our approach. So first is, we are very well diversified. We have an earnings stream which is also non-NBFC related. On top of that, we also raised equity. We raised equity in an NBFC business. We are raising equity in an advisory business. So we've been very quick to move. As I said, a year ago itself, we said, maybe things will slow down, but we will become stronger. So we have done all of this to make sure that we adapt to the environment, because obviously, as you correctly said, environment has got worse in the last 1 year. But I think the worsening of environment is over, and at least in the last few weeks we are starting to see stabilization coming in. So if you all just look at information, keep calm, and then say that let's allow the economy to recover and the government actions and the RBI actions to start bearing fruit, so that India gets back on growth. And once growth comes back, a lot of these issues will also start easier and easier to handle.
Yeah, one doesn't have much of a choice but to really keep calm and sit back. But Rashesh, out of that 20% real estate exposure that you have on your book, 160 projects like you said, how much of them are under stress and problematic? If you could just, put it in numbers for us.
See, if you look at our stress, our total stress on wholesale book is about, our overall GNPA is about 2.5 or so. And overall stress on wholesale is about 3.5 to 4%. That's the NPA number. But as I said, not every account which needs to be watched is an NPA, because some project need last mile funding, they need some hand holding, they need some governance oversight and all that. And with the new rules and all on real estate, all this has become much easier, because now project cash flows can be controlled very well, they can't be diverted. So but you need to have controls and oversight and all that. So we usually have seen that about out of 160, about 30-35 projects are what we are always under watch. Not all of them are under stress, because as I said, a lot of them are economically viable. You have to just ensure completion happens as per schedule. So our gross NPA number for the book as a whole, as per last quarter, was about 2.5%, and the net NPA is around 100 basis points.
Tell me, what is the kind of chat that you're having with those developers? I understand there is a lot of hand-holding required, as definitely they would need it. And also wanted to understand, how liquid are you right now? What sort of credit lines do you have, if the need be, for these 25-30 projects that you just talked about?
So actually a lot of these projects are already well funded, plus we are also arranging for other banks and global funds to provide last mile funding, so that we keep dry powder on our own balance sheet. A lot of these projects, our estimate is the total portfolio needs about 1,000 to 1,500 crores of last mile funding to complete, out of which a lot of is already organized. We have arranged it through global funds. We are arranging it through Indian banks also, who are coming and stepping in for good, viable, economically viable projects, providing the last mile funding. And overall, we have given our liquidity profile in the investor presentation. We keep a 365-day horizon on liquidity, and we try to maintain between 15 to 20% of our balance sheet as liquid and liquidable assets. So we have been for the last 5 years been in that range, and our endeavor is to keep that kind of liquidity. It's expensive to keep that kind of liquidity because it is costing you earnings and money and all. But at this time, that's a good thing to do. So we have maintained that. A lot of that data is in the investor presentation also. And we have also a lot of global funds who are partnering with us on asset management. We have raised a lot. We have almost 30,000 crores in credit funds, where global investors have given us funds for investing in credit strategies in India. So a lot of these global funds are getting very excited for earning 14, 15, 16%. So an average project which needs last mile funding can raise money at 14, 15, 16%. And there are a lot of global funds who are now stepping in and providing that particular kind of funding. So India credit is getting very interesting, and we are seeing as global yields are coming down, as India interest rates are coming down, we are seeing more and more interest from global institutional investors who have been playing in Indian equity markets, but now they want to play in the Indian credit market. I feel another 4-5 months will see a huge surge of liquidity from global funds into Indian credit opportunities and yielding opportunities. We're already seeing, transmission lines and pipelines and roads. A lot of these global funds are coming and buying those and earning 12, 13, 14% returns, yields on those. And that, I think, is a new opportunity. We already have an asset management business that capitalizes on this. And our idea is to help a lot of these global funds channelize into projects. So when we work with projects, we estimate what are the last mile funding requirement, how much we can do, how much we can arrange from the funds that we have and the partners that we have all over the world. So we have been fairly agile last 4-5 months, talking to a lot of funds, bringing them out here, taking them to site visits and showing them what kind of opportunities are available in India to earn 14-15% return. And India is becoming a very interesting market from that point of view.
Okay, thanks very much then, Rashesh, for joining in and giving us your take as to how things are shaping up within the company, the real estate stress, as well as the outlook on your wholesale book. Well, let's just deviate a moment from corporate